let's jump in. A couple things I want to bring to your attention before we look at the slides. For those of you who live in the wonderful California area, or those who wish you did, we have a couple seminars coming up, free live seminars. It'd be great to meet you. I will be out in less than 3 weeks, February 20th, in Huntington Beach, the surfing capital of the world. That'll be Thursday, Feb 20. We'll be having an evening seminar at the Huntington Beach Central Library. You can get information on our website on that and sign up. As far as today, let's jump in. I'm introducing a new class that will be starting a week from Tuesday, and I think very appropriate. And I've labeled it Trading in a Volatile Market by the Greeks. How many of you agree we're not always going to have, like we've had the last 5-6 years, an up market? So you could just sell put credit spreads or buy call verticals and get your money, go to the bank and buy your wife flowers. How many agree that we're not in that market right now? We may not be for a while. Just to give you a couple quick bits of information, this for educational purposes today. A new class schedule. These will be the 6 classes. We'll be starting Feb 11th, a week from Tuesday. It'll be all February. 6 classes. Those are the dates. Each class will be at 1 Central Time. All the classes will be recorded and archived. You'll have your own class page where the PowerPoints will be on there. And you can ask questions on that page, and they'll come to me. So even if you watch it recorded, maybe you can only watch one live because of your work schedule. You'll be able to ask questions. And even like 3-4 months after class, you'll be able to ask questions. It'll continue up on the class page, so that will be helpful. And I just think for those of you, Greeks can be a very, esoteric thing. What do you do with these things? And so this is going to be probably one of your more practical classes you've ever taken on the Greeks and how to use it practically in your trading. And it's like, it really, I always think of, when I think of managing by the Greeks, all those different things. What do you call them? In the cockpit of an airplane. What do you call them? All the different. Basically, a pilot is flying by the Greeks. Instruments. Thank you, John Schenkel, a would-be pilot here. But you have all these instruments, panels, and they're using these to the pilot to help them make decisions. And that's really how market makers trade, right? Retail traders will trade by the rules or the rule, but market makers don't do that. You can't, because there's other factors that you can't put one set of rules on every strategy, right? Depending on market conditions. So I think there'll be a very appropriate, helpful class. Some of the class topics to be covered, but there'll be many others. We'll be going through a lot of different strategies, but how to use the Greeks practically in your trading, what the Greeks tell you and what they don't tell you, how to set up the right strategy for the right market condition, how to use the Greeks in adjustments. A lot of people use the same adjustments for the upside as the downside, and you can see don't work like that. The downside is downside's like Alaska, the upside's like Miami Beach. They're totally different. Ideal Greeks in up and down markets, how VIX dictates ideal Greeks for each strategy, why market makers managed trades by the Greeks and not managing trades by specific rules like retail traders use. And part of that, since I was one of those guys for many, many years, is because it's a lot more thorough when you're looking at the Greeks. It's more adaptable to different market conditions. You shouldn't do the same adjustment or same strategy regardless of VIX levels and market conditions. So this is another topic, how to trade multiple strategies in the same vehicle by the Greeks. Those of you who might trade 2 or 3 different strategies. How beginners can use the Greeks in a simple way to manage their trades. So I think this would be very good for whatever level you're at. This will be helpful. Live example, trade examples in every class showing you how to pick and manage by the Greeks. Peter says, is it about the advanced Greeks? I don't know what that means, advanced Greeks, or are you saying is this an advanced class? I try to, with the examples and stuff, make it as practical and understanding. That's the key. But I would say, if you're as advanced as you think you are, you'll get a lot out of this, right? And if you're a beginner, you'll get a lot out of this. I managed by the Greeks, the CBOE as a specialist for over 20 years. And so, and we did it on, there were positions we would have with hundreds of strikes, or not hundreds, but maybe 50 different strikes. So I think advanced folk will get a lot out of it. Most retail traders that say they're advanced, I mean, advanced or medium, it's all in the eye of the beholder, right? But I think it'll be very practical class, whatever your level. And again, you can ask questions wherever you're at, and we can help you. All right. So let's jump in. Again, here's SPX price chart. We finally, after a pretty quiet last 3 months, the last week, they say because of the virus thing, right? The market's gone down. But you know what my Irish grandmother would say to that? That's a bunch of baloney, right? What else would she say? She'd say that's a bunch of malarkey, right? In other words, if we didn't have the virus, was the market due to come down a little bit after being up almost 30% last year? That's a tough question. I think you need a Harvard degree to answer that. But if you don't have a Harvard degree, you could probably still answer that, right? So if we didn't have the Chinese virus, was the market, and we were down like this over the last week, would that be surprising? Somebody say no. I need somebody to just humor me so I can keep going with this. No. All right, I'll give my answer. No. All right. Bottom line is, I don't care if it was China or if it's going to be the Chicago Bulls. We had to come. This is normal, right? You don't rain in Miami Beach for 8 months, or you don't have a hurricane for a year. Come on, right? China, whatever, it doesn't matter. We need to come down. So it looks like we're coming down, coming near the 50-day moving average, still a ways from the 200. Again, your VIX has popped up to 18, first time in a while. And again, most corrections aren't 20% like they were last Christmas, right? Most of the down moves might be 2 to 5%, right? You look at this little bit of down move, barely 2% or 2 to 3. Here's some other ones. This was like in August, but this is a 6-month chart, so it doesn't go back that far on this one slide. But the key is, what gets us unnerved on the downside is these big candles. Things move faster going down than they go up, right? The ATR, which measures the size of these candles, the width has really picked up over the last, here it is here, I'm sorry, over the last week or two. And so we're kind of backing off short-term trades for now, 7 to 15 day. Is it time for what types of strategies? Well, with the VIX over 18, more volatilities that would benefit if the volatility came down. But again, we have to be cautious, right? Remember Mary Poppins? When did Mary Poppins leave? When the wind was changing. So the wind might be changing a little bit here. Be cautious. Yes, I am doing butterflies and iron condors, and I'll put one on here at the end of the day, a little bit further out duration. But I still am being a little cautious because we're just starting to maybe get a little bit of a range here. But I think next week I'll feel more comfortable possibly doing a little bigger size, but we'll see. But we're getting quite a bit of movement. After not having a 1% move since October, in the last week we've had what, 3 of them? So be patient, right? What's that? Be patient. Patient, amigo. All right. So since this class will be about the Greeks, just talk about the Greeks for a few minutes here. And I looked at a stock that actually, not that this is an ideal stock, this is an SPX. I'll look at SPX in a second, but here's Disney down barely anything today. So here's a stock that wasn't down much. It's been down a bit, but it isn't down much at all today. And how many people would say, hey, Dan, at these levels, I'd buy 100 shares of Disney and hold it for 2 years? Anybody would say that? Hey, Dan, at these levels, I wouldn't mind buying 100 shares of Disney in my retirement account. All right? So we have a 1-to-1. Eric says he would. Homero says no. Who's going to break the tie? Somebody needs to break the tie. Okay, Charles breaks the tie. A yes. So we have 2 yeses. Robert says no, not yet. We have a 2-to-2. Anybody willing to break the tie? We have a 2-to-2. Kathy just says, why tie up the capital? Kathy, I agree with you, but go. Leo says, go for it. Leo's going to buy 100 shares of Disney just to get the things going here. Samuel's buying 100 shares of Disney. Good. All right, what's the point? Point is, I call this the long portfolio, kind of the view of an investor. That's where you would do covered rights, cash secured puts, or this would be a covered right alternative, something that's going to be much cheaper. And that's what I mean. You could use leap options, but you get a little more expensive leap options, but we're just going to sell something against it. So you can buy leap options. I just bought an in-the-money option instead of a leap a lot closer in. See, why did I do that? A lot cheaper, right? But what's the point here? Point is, if you did one covered right in Disney with the stock at $140, or you did one cash secured put in Disney, about how much are they going to ask you for? About how much capital are you going to have to take out of your wallet to do one covered right on a $140 stock or one cash secured put? Give me a number. About 13 big ones, right? 13 G's, right? To do one. So I say, instead of spending 13 grand, how would you like to spend 1,000? Basically do the same thing. Would you listen? Danny, you telling me I could spend 1,000 instead of 13? Lewis says, Dan, I got so much money, 13 doesn't matter. Okay, Lewis is going to spend the 13, but the rest of you spend 1,000, right? So I'm buying an in-the-money with the stock here, an in-the-money April 125 call at 15.30. That's my stock surrogate. Instead of spending 13 grand on the stock, I'll spend 1,500 on an in-the-money option that is basically going to duplicate pretty close to it what stock will do on the upside. Except it'll cost less, so the yield will be better. And then I'm going to sell a out-of-the-money 140 call in the March 6 expiration for 440. My longs are 77 days out. My shorts are 35s. Could I buy leaps? Yeah, but I'm going to do this every month. This will be cheaper dollar-wise than if I were to go to buy a leap and then sell a call. Here's my margin. And so you can see we're talking $1,000, and you can see where the expiration line is. We're at 137.79. You can see where the expiration is at 140 and above. It's almost near $500. So you're talking making about over $500 divided by capital of what? If we do this once, what's that going to be? About 50%? Not normally that high, but this is a good return. But what would somebody expect? For those of you who do covered rights or cash secured puts, what's a reasonable return per month on cash secured puts or covered rights? What's a reasonable return on your capital per month? All right, Kenny G says 1 to 3%. Someone says 2 to 3, 1. I say maybe realistically 0.5% to 1, right? I say around 1%. George, I wish you were correct. Yeah, 2 to 3, but I think 2 to 3 is high, right? For a covered rate. Say, why do you think that's high? Maybe in a high volatility environment like we are now, but why do I think that's high? Because you got to put up the stock. Why would you put the stock up when you could go buy the in-the-money call, right? Yeah, as Tracy said, it depends on volatility. You know, right now, with VIX at 18, you could get a little higher return. But again, the returns on long diagonals, which are a cash or a covered rate alternative, or we do these wide put credit spreads as an alternative to cash secured puts, the yields are much, 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 much better. But if you look at the Greeks, what does a delta of 34 tell you? Right? Think in terms, if this is the underlying, delta of 34, think in terms of stock equivalent. If we go down 34, if we go down a point, we lose 34 bucks. If we go up a point, we make 34. That's deltas. Stock, for those of you who are more used to doing stock is like 100 shares is like 100 deltas. There's just a symbol for delta. And so if you own 100 shares of stock, goes down $1, you lose 100 bucks, goes up $1, you make 100. So with stock, whether it goes down $10 or goes up $10, you still have 100 shares. The thing with options positions, as you go up or down, your delta will change, right? So if Disney is 137.79 and we go down $1 to 136.69, right? If at the current price 137.79 my deltas are 34, what will my deltas be if we go down $1? What's an approximation? Hint. There's something to do with that. So what will my new deltas be as we go down $1 from 137.79, 136, excuse the bad math, 79. Hint. Look at the gamma. So deltas and gamma refer to price risk. So if you're long the equivalent of 34 shares of stock now, if we go down $1, you would add your gamma, right? And we'd be long 35.5 shares of stock. So you're getting longer on the way down. Do you normally want to get longer on the way down? Not usually. So gammas are basically telling you how your deltas will change for a 1-point move in the underlying. Theta is telling us, because we're selling this out of the money option and it's all extrinsic value, what you're getting some positive time decay each day, and that number will grow. Vega is saying we're a little bit long Vega, so as the volatility goes up, we'll get some benefit there. So we're looking at these Greeks, and again, I think the most important Greek is delta. The second most important Greek would be Vega or volatility. So this is more, someone who would do these type of strategies would be more in your long, the view of an investor in your portfolio type thing. But we'll be doing a lot of that in the class, looking at the Greeks, not only what the Greeks tell us in terms of how to manage the trade, but at the beginning of the trade, based on the levels of the market, which we're going to look at in SPX in a second, and the VIX and different things like that. What Greeks do we want? How do we want to set up a trade right now? Do we want to set up with the VIX level where it is? Do we want to set up a trade long Vega or short Vega? How do we want to set up a trade, right, with the Greeks we want. What Greeks do we want in the current market environment based on the price levels of the market, the speed which we're moving in the VIX? And then once we get the trade on, using the Greeks, how to manage it. The Greeks can help us, know when to adjust. And with the way the Greeks are in market conditions, what types of adjustments do we want to do? How do we want to change our Greeks at adjustment? If you look at SPX, when I was looking at the market, SPX is 32.28.8. What's the SPX right now? Gamma and theta aren't as important. I mean, they're important when you have a high, gamma is telling you how your deltas will move against you for a $1 move. And as you have more short-term trades, 7 to 15 day, your gamma, if you're selling more like butterflies or iron condors or credit spreads, days like today will be very painful. In other words, if you had an iron condor coming into today's 50 days out versus 10 days out, the 50 days like a pimple on an elephant's behind, no big deal. But if you had a 10-day trade coming into today, it's a little more troublesome because the shorter the duration, you have more positive theta, but a price move can hurt you. So here we are at 32.80, and based on the market level, because the market's going down, VIX is up near the 18 level. So when VIX is up near the 18 level, and we're moving fast like this, I would want more Greeks that are going to be short Vega, and I want very low short Gamma, right? So I have to go further out in time to get this low negative Gamma, and I have to sell options. So that's what I want to do based on the current VIX levels, how fast the market's moving, other indicators. I want to set up a trade with the Greeks if I'm kind of an income trader. Peter says to use a spreadsheet, too much math. I don't use any spreadsheet. And Peter, I don't know what math you're thinking of, but I don't see any math to do here. I don't think I was much better. I don't think I made it through 4th, 5th, or 6th grade math. So Peter, whatever math you're thinking of, I have no idea. There's no math. All I said is the word gamma. If you don't like the word gamma, call it your favorite sports team. Call it the San Francisco 49ers. And if you don't like theta, call it Miami Beach, whatever you want to call it. Gamma and delta refer to price risk, theta, time decay, vega, volatility risk. So when the VIX is higher, I like to get short vega because we think the volatility will revert to its mean, which is much lower than 18. So on a day like today, I went out and we're looking, and I'll put a live trade on in a second. I sold a 3,400 call, about 170 points out of the money. This was the price I sold it for. This was the volatility at the time. And then I bought a hedge 10 points away. This is an out-of-the-money call credit spread. And that's one of the foundational parts of a iron condor. Then I went to the put side and sold an out-of-the-money put, 2940 put, almost 300 points out of the money from the VIX this level. So we're setting up this the kind of Greeks you want in a high volatility environment, and we're bringing in $2.20 on this entire credit, right? So it's a range-bound trade. And as long as we're between these strikes at expiration, we make the credit. That's the easy and simple way of this. Your margin or risk for every one contract is about $780. You take the difference between the strikes, which would be $1,000 less the credit of $220, it'd be about $780. And I just, on this particular one, I chose the strikes by picking the call with a delta of 12 and the put with a delta of 13. Very easy to put on. I mean, range-bound trade. But again, the key is with the high volatility, there's certain Greeks we want to set it up. And I want to be a little bit short. So I want to be short Vega. I want to be a little bit short Delta versus my short Vega. So the Greeks, it's important based on market conditions. It's important how I set up the Greeks, what strategy I choose. And then once you get them on, how do you manage the Greeks? Right? Very fluid. It's not hard. It's only hard if you've never done it. Right? How many of you think this is hard? Right? I want to show you something. How many of you think this is hard? Managing by the Greeks. Patrick, all right? Anybody else? Now, I'm not saying Peter says it's risky. This is less, it's not. Walking across the street's risky. But my question is, for those of you who are saying it's not easy, right? You ready for this? Have you ever done it? For those of you who are saying it's hard, and I'm not saying it's easy, I mean nothing. But my point is, have you ever done it, right? What I'm thinking about, I have a granddaughter who's in England, right? You know what she thinks is the hardest thing in the world to do right now? Ride a bike. We got her a bike at Christmas. She's 3 years old, right? She still can't ride it, right? Peter, you remind me of Archie Bunker. You lose your account with SPX credit spreads. You don't lose your account with SPX credit spreads. You lose your account when you don't know what you're doing and when you don't manage it. So we're going to teach you in the classes how to manage these trades, right? You're right. If you're a pilot in the cockpit and you don't know how to fly and you don't know what you're doing and you fly a plane, will there be a good outcome? So if you're in the pilot, if you're in the cockpit with those wonderful instruments and you don't know what you're doing and you don't know how to fly and you try to fly, right? It won't work. So yes, if you try to manage an iron condor and you don't know what you're doing, you don't know how to trade an iron condor, you've never traded iron condor, will it be a wonderful experience? No. That's why we're teaching the class, to show you with live examples how to do this thing. So if you look at this example, we're putting this trade on for a 220 credit. The margin is 780. And if I say I'm trying to make about 10, let's say 8%. 8% on almost 800 bucks, be about 65 bucks. So if I sold it for a 220 credit, I'd probably put an order in to buy it back at 155 debit. And so then I'd make about $65 divided by your margin of 780. It'd be about 6 to 7%, right? And then I don't want to lose, if I'm looking to make 6 to 7%, I don't want to lose more than 9 or 10%. So about $70, $75. So if this credit goes up towards $3, I'd get out. So it's, again, having a plan. Having a plan. We won't get into adjustments right now, but again, the big things in the class that we'll be working on will be based on market conditions, the VIX, the speed, how everything's, some different indicators we're looking at. What Greeks do we want? What Greek characteristics we want for our trades? And then second, once we get this set of Greeks on, how do we use it to manage it? And whether you're doing a simple strategy or more advanced, we'll go through these and show you. So I think if you've been looking for how to manage trades, how to do this as a business, this would be a good practical class for you. And I'll do various strategies to show you examples on this. And the nice thing is we are in a little bit of a volatile market. So whatever the market throws at us the next month, we're going to navigate through it and show you how to do it. So anyways, that's my 2 cents. again, you can sign up for the class on the front page of Shared and Mentoring. I don't know if anything's ready on there yet. Johnny will send out the recorded video of this class, and then we'll probably send you a few emails. But the class will be starting a week from Tuesday. And so, and I'll share a lot of what I've learned over the years, being working at the CBOE as well as doing this, teaching retail traders the last 14 or 15 years. So I think a good appropriate time for this with the volatile market, how to manage trades by the Greeks, give you a good understanding of the way traders have always managed their trades, professional traders. So thanks everybody for showing up. Look forward to seeing you a week from Tuesday. Have a wonderful, wonderful weekend. Thanks.